Alright, so שלום, מאזינות ומאזינים. הפרק הזה הולך להיות באנגלית, אז אני כבר מכין אתכם אם קשה לכם ואתם מפחדים לשבור שיניים או אוזניים, אז קחו את זה בחשבון. נמצא איתי פה אורח מיוחד, I'm gonna now move to English. Azdra Gardner, who is an investor, investing in Israeli startups, דיפ-טק startups mostly. He's the co-founder and chief investment officer of Verana Capital, which is essentially a VC that invests in Israeli companies. And he's also the co-founder and CEO of Gesher Acquisition Corp, which is, as you described it to me, kind of like a financial vehicle or a special purpose vehicle that help Israeli startups to go public in the American market, which is very interesting for some Israeli founders that actually want to make it big in the US. So Ezra, hello, shalom. Welcome to Israel for not the first time, I would assume.
Shalom. Yeah, no, it's great to be here. I'm here every month, actually. So
Wow.
It's definitely not the first time.
Okay, great to meet you. So thank you for coming to the podcast. I'm humbled to host you here, as we like to say in English. Tell me and the audience a bit more about yourself, Verana and Gesher, like all of your, maybe a bit of a personal background, just very quickly, so we'll have time to discuss other stuff. And then what would be Verana and Gesher
Sure.
consecutively?
So Verana is a firm, as I said, that I co-founded 15 years ago. So we've been investing for quite a long time in the Israeli market. The best way to describe us is an Israeli-focused VC fund. Turned 49 years old last week.
Mazel tov.
Thank you. 4 kids, 2 crazy dogs.
You look no more than 30.
Thank you. So we have a busy life. We have offices in Denver, where I live most of the time, New York, and also Tel Aviv. Typically before the war, I was coming here about once every 2 or 3 months. And since the war started, we started coming here much more often, once a month. We raised, the largest emergency fund post October 7th, which we've been deploying rapidly. That was the intention. We still have some more funds to deploy there, but it's probably 75% deployed.
Wow.
And on top of that, the Gesher product that you talk about is designed to take Israeli companies public on the NASDAQ. And, we set a goal 3 or 4 years ago when we launched the product that in 5 or 6 years, we would want every Israeli entrepreneur that was suited and wanted to go public on the NASDAQ that was less than a $5 billion market cap that, we would be the first stop to come to. So I think we're on track for that. We're already on our second vehicle, getting ready to launch our third one. So, that's in a nutshell what we're doing. What else can I tell you? We can talk about anything you want.
I have so many questions. I'm going to start with the easier ones and then we'll go to the harder ones. Let's start with your affinity to Israel. Why coming out of Denver, investing in דיפ-טק, maybe wanting to take דיפ-טק companies into the public market in the US? Why Israel? It's kind of like a cliche question, but I'm wondering about your tech. Definitely nowadays, considering, all the geopolitical turmoil and what's going on with Israeli tech.
Yeah. Well, I guess I can take those in order. So why Israel? My mother was 9th generation born in Israel. I was raised on Zionism. That was my religion. So I've always had a strong affinity to Israel. I was conceived in the Me'onot in Beersheva when my dad was teaching as a professor there. So
oh, wow.
That's one of my claims to fame. Prior to founding Verana Capital, I was totally involved only in the public markets, public equity markets, primarily the U.S. My last job there was I was running UBS's equity long-short principal investments business for the Americas out of New York. When I started Verana, the idea was not to be a דיפ-טק VC investor. It actually happened by coincidence. It was born out of something totally random that I had no idea was going to happen, which was that I had built this whole career investing, being one of the largest investors in these big public companies, so that I was what I call a friendly activist. I was always consulting with the CEOs of the company, presenting at their boards of directors. But we were, a large firm, UBS, $500 billion in, AUM at the time that I was there. So you could be the largest investor. When I went out on my own, we wanted to continue that strategy, but of course we had to invest in much smaller companies in order to be one of the top investors.
Yeah.
And at some point I realized that it was essentially like I was investing in private companies, because we were taking these huge positions in small companies that were illiquid. So like a private company, we didn't have the liquidity, but unlike investing in a private company, we didn't have the information because they were public. So it was like the worst of both worlds. Okay. So at that point I said, well, what's the difference? We might as well invest in private companies. And for me at that point, there was no question where I wanted to do it. It was a choice then to go to Israel. I had actually, right before I started Verana Capital, I had been living in Tel Aviv for 4 years, helping build an alternative asset management business. It was actually during the global financial crisis. And when that opportunity left and I started, Verana, when we shifted to the private companies, Israel was the logical place for me to go. It's where I wanted to go.
Okay.
You said, why דיפ-טק though?
Yeah.
That's interesting, right?
Yeah.
Well, that
in a realm and a context where, and I'm talking about this topic with a lot of Israeli founders and Israeli VCs that are actually doubling down now on the Israeli market. And the whole there's, I would say, similar theme in their mind. They're saying it's a special one, but it's a similar one when they are actually shy away from דיפ-טק and they're doing more things related to cybersecurity, infrastructure, specifically for AI and enterprise sales, which is what, for the last few years, you look at some of the outliers, Israeli tech has been, I would say, being very prominent and strong in those realms. And then saying, I'm going broader on דיפ-טק, it's actually a brave decision to do.
Yeah. So let me tell you why people hate דיפ-טק and why people love software.
Yeah.
Okay. People hate דיפ-טק because it takes a really long time to get to revenues. There's a much longer development there. And to make it worse, it costs a lot more money to get to that product, right? Which is why people love software, because it doesn't take a lot of money. The old myth of the two Google guys sitting in a garage and creating an algorithm that would create this multi-$100 billion company. And then when it hits and it goes to the market, it's really quick. So sounds really appealing, right?
Yeah.
Why in the world would you want to do דיפ-טק then over software? Well, I think the story that people never talk about is that, while it's true that you can develop an enterprise software or cybersecurity product for much less money and much quicker, and if it hits and it grows in the market, you can have ARR just take off right away. But this is the survivorship bias. It's the obvious example of survivorship bias that you hear about the stories when it went really well. You hear about CyberArk. You hear about this. There's 1,000 times more stories of that fun thing to do, which is invent a product really quickly for really cheaply that goes to $1 billion in ARR really quickly. Doesn't happen that often.
Yeah, it's not over a representation of what's really happening in the market. For every one that makes it, you have thousands that do not make it.
And it's also not measurable in terms of whether or not it's going to be a success. So whereas in דיפ-טק and hardware, we ask ourselves two questions when we look at a company. We say, can this be built? And if it was built, would it be important? And those are things that you can define. So for example, let's say that you want to invest in a company that makes electric motors, okay? And you say, we're gonna use a totally new methodology. We're gonna clean piece of paper to design and engineer an electric motor. And this new design is gonna make it 2-3 times more efficient, power dense, cheaper, okay, to do.
Yeah.
If you could build that, if you could figure out if you could build it, I promise you it's important. Because everybody wants to have less rare earth metals used in their electric motors. Everyone wants a lighter, cheaper, better electric motor, right? Okay, and these are definable parameters that you can actually think about, right? If you talk about enterprise software, let's say someone has a great idea for a new CRM, okay? And they show it to you and they say, this looks like this could be way better than the Salesforce CRM, okay? But then ask yourself the question, how do you know if a CTO is going to buy that, is going to rip the Salesforce enterprise software out of their organization? How deep does it go? What are the tendrils that they have? How do you make that decision? I don't know. And this is actually something that goes back to my UBS days. And the reason that I focused on industrial companies, aerospace, automotive, mobility, what you call hardware. Okay. Because I never understood, there was tons of retail, field trips to invest in, what's J. Crew going to do this season? The research analysts would say we're recommending Gap because Banana Republic has a wonderful color palette coming out for next season. What do I know about that? I don't know. I have no idea what color shirt you're going to buy. Someone may know, but it's not me.
Okay.
And so that the translation of that to the private markets was industrial tech. Essentially, investing in industrials, investing in aerospace. What's the analog to that in the private markets?
Yes, so simplifying it, we use really deep tech capabilities and deep tech oriented teams in order to solve real deep tech problems into industries that would be essentially somewhat old school. We're going to reinvent a motor. We're going to reinvent a supply system or whatever that means, right? So you are not going for the obvious realms of let's do some software for a business unit or for some software for fintech, etc., right?
Yeah, I mean, at the end of the day, I realized a few years ago when I was looking at my current portfolio, I said, in some way, shape, or form, every one of my investments is figuring out a way to use less water or less energy. Now, it's not because it's an ESG fund. I mean, this was something from 20 years ago. They used to call things that. But it's basically like, what is the industrial complex or the economy of the world actually need? They need to use less of the most scarce resources, the most precious resources, water and energy, right? And so that is what goes through pervasively every single deep tech investment that we look at, whether it's a semiconductor. A semiconductor is a great example of deep tech, okay?
Yes.
And Israel's very good in semiconductors, okay? Have been for years. Well, what are semiconductors trying to do? Of course, they're trying to do things faster, better, cheaper, but also everything that's going on right now in the semiconductor space is about how do we make something that consumes less energy? Because energy is being consumed, and it's not because
same or better compute power with less energy and less space also.
Exactly, and so
you can have a smaller iPhone, etc.
Right, that does more. And by the way, they aren't doing that from the thought process of, I want to save less dinosaur juice or something out of the ground, less oil. They're doing it because that's what the customers need. The customers need things that heat up less, that take less power to run, to cool, all of this. So that's what they're doing. The motor example is the same thing. And software is like a productivity tool. Productivity tool is also great, right? But it's not as measurable. It's not as measurable to say, if you buy this semiconductor chip, you're going to reduce your power consumption in your data center by 90%. Mm-hmm. That's real. That's tangible and measurable.
So you have the venture fund Verana, and you invest directly into Israeli tech companies, right? On an early stage or later stage?
So we are totally agnostic to that. We come, every time we form a fund, we come up with a thesis about where we think the best risk reward is. Mm-hmm. And we've done everything from early stage investing to mid-stage, to crossover, to taking companies public with the Gesher product.
Okay, so let's talk about that. That brings us to the Gesher project.
Yeah.
And I want to draw the Israeli card. I always tell that to my American colleagues when I talk with them. And that actually a preparation for me being a bit rude. Okay, and saying, there is a false prejudice about what SPAC is, because we all as consumers and as people who understand the financial markets got exposed to this term during the last 4 or 5 years, and definitely at the peak of the bubble of, let's say, 21, 22. And we saw a lot of people putting companies public via SPAC, and eventually some, or if I would be gentle about it, most of those investment went down to the drain. And then people say, okay, no, SPAC is a scam. So I want to just, confront with you very directly about that and let you kind of create a counter argument about that.
So SPACs have been around for around 35 years. My partner and I have been investing, running every element you can imagine for 21 years. 2005 is when we did our first SPAC. The evolution of the product has changed significantly since the time that my partner and I started doing it. I'll give you the biggest example.
Yeah.
The biggest example of what changed is that, 20 years ago, what would happen is, let's say you're the number 3 guy at Nike, okay? And be a nice job, why not? But you're getting passed over for Phil Knight's going away, and you thought you're going to get the CEO job, but you're not. But you happen to know a lot about shoes and marketing, stuff like that, okay? And a SPAC sponsor team would come to you and say, hey, why don't you come and be the CEO of my SPAC, all right? And we're going to go find an athletics outerwear company, shoe company, maybe Reebok, maybe Adidas, something like that. That's a great company that's got lots of sales.
And they're just private. They're not in the public market.
Yeah, they're in the, and they're not doing as well as they used to do. You know, their sales were going up by 10% a year for many years, and then they just started flagging and going down.
Okay.
What if we use our tool, and you're being the CEO of the SPAC, to go and to acquire that company, take it public, and you turn it around, and we would give you a whole bunch of warrants, you know, incentive, like equity incentive, to turn this thing around and make it and make it work in the public market. And that was kind of what the tool was used for back then.
Yeah.
Okay. There were several more cycles of it, and fast forward to kind of 2020. Okay. And, you know, famously, Chamath Palihapitiya started doing a new generation of SPACs.
Yeah. For those who don't know the guy, he's the Chamath from All In podcast, which I, by the way, love listening to. So yeah.
And Chamath said, listen, there's a lot of growth equity tech out there that's private that could use a large amount of capital, where I'm not bringing the CEO. The CEO there is great. Right? He got Virgin Galactic was one of the ones he did. You have all, you know, the board is great. What I'm doing is I'm bringing a way for the company to go public, okay, where it's maybe a little bit harder to figure out if this company is going to be a good company or not, because it doesn't have revenues right now, or maybe, you know, it's in an emerging tech field. But because I'm Chamath, okay, and you know me, I'm a great tech professional investor, I'm going to go do the due diligence. So you can trust me, because I put money, my own risk capital at risk, that I would not take this thing public unless it was a good company. Okay. And the market was used to this in another arena that no one ever says boo about. No one ever says it's bad. And that's biotech. Everybody has known for decades that it's okay to bring a company public that doesn't have revenues if there's something else that you can actually analyze. So for a biotech company, you get through phase 1 FDA trials, you get through phase 2 FDA trials, and now everybody knows you need another $250 million to get through phase 3. And you're not going to have revenues until you get through phase 3. But $250 million is more than you can raise in the private markets. And there's actually something to analyze. There's data from phase 2, right? You can say, I can make an educated guess if this is something that I understand.
Yeah, that's going to pass phase 3 and then become commercialized.
And you can even make an estimate also about what the value of the company could be, because you know what the TAM, the total addressable market, is for this drug. Maybe it's a cholesterol drug, or, you know, whatever it is. And you can make an estimate about what the price would be, because you understand what the payers, the insurance companies do. So you can actually analyze the valuation, and you put a probabilistic, coefficient on the front of those estimates, and you come up with it. So everyone's heard about that. No one said boo about that. Okay. All of a sudden, you know, Chamath said, well, what about Virgin Galactic, right? That this is a great example. They don't have any revenues. We don't know if they're going to finish the design. We don't know what it's going to cost and what they're going to charge for it. But Chamath said, you know what? We can actually estimate that. We can look at what they've done. We can figure out how much more money they have to spend. We can look at what the regulatory environment is. What would they need to get approved? Just like when a new Boeing plane gets approved or something and what would be the customer base? What would they pay for it? We can do surveys. We can figure that out. And that makes sense. And he brought this, and this was a great idea. Okay. Now, you know, there's a saying, they say what the genius does first, the fool does last. Yeah. Something like that. Yeah. Forget exactly how it goes. But
so you're trying to say that some good SPACs showed the way to a lot of others that were not so good.
That's right. And you
paved the way, let's call it this way.
And you want to know when that happened else? .com. Okay.
Yeah.
Before anyone was doing any SPACs with there. Okay. When Amazon and PayPal and eBay and all these companies went public, you know, that was a great idea. Pets.com, you know, all these other ones.
Yeah. So I want to just recap because I think it's gonna make sense to the audience to kind of like understand, because we didn't really say what SPAC is, right?
Right.
And you kind of like give the example of the ex-Nike executive that wanna find a I don't know, like a sports wearable company in order to take it public, rather than a sports company like Reebok, who is private, want to take itself public and then needs to find funding in the public market. In SPAC, it goes the other way around. You bring the supply or the demand before the supply. You're going to say, we have investors that are willing to put money in. We have the executive or the leadership that want to take this company. And because taking company to the public market, it's a lot of bureaucracy and logistics and overhead and money, then we're going to search with this consortium of investors and this leadership team for a company in a specific space, in a specific stage, in order to take them public and bring them to the public market. So that's kind of like the Nike example. I think that what you mentioned about what Shamat did, and it's not just Shamat, it's also happened here in the Israeli public market, yeah? And then we're going to wrap up and kind of like move on to the Gesher thing, because we didn't mention anything about that. Then I think they brought the same mechanism with, as you mentioned it about Shamat, with kind of like the state of mind or the framing of a venture investment in a way. So to give an example, there were some Israeli tech companies that were startups, pre-revenue. Some people assume that they're going to make a lot of revenue after getting into the public market. So they gathered up a consortium of investors, brought a leadership team of people that are very well known within the Israeli or American market, and then took some startups into the public market. But those startups weren't ready because they haven't have revenue, and those assumptions that has been made by those investors haven't come true. So I think that what you're describing with the first example of the ex-Nike executive looking to buy Reebok into the public market is very different than investing in a venture fund as a venture fund into the public market. You know what I mean?
Yeah, but those have always been the two like sugim.
Two routes, yeah, two types.
Right? That you've got the I've got a company that's been a very successful private company raising hundreds of millions of revenue. Time to go public. Okay.
Yeah.
Everybody knows about this example. Okay.
Yeah.
But you have another example on the other side, which a lot of things fall into that category, and I've called it myself. I made up this term: completion of complex science project.
Yeah.
So the obvious example that I told you that everybody knows about is biotech.
Yeah.
But it's also space tech. It's also nuclear power. Okay. It's also quantum computing. Mm-hmm. Maybe you've noticed that. Okay. So there's lots of things that fall into that category. And guess what? This is what the equity markets are built for. The equity markets are built for growth. Okay.
Yeah. And to fuel those דיפ-טק companies that might not have revenues, but could get another extra funding from the public market in order to get going, in order to reach to the stage where the technology has been mature enough and there are revenues in order to build a big company. And it's a risk, right?
Right.
Like,
and it is. But
like we do with all investments.
But the markets are smarter than you think they are, actually. Okay. So even if you go back to the peak in 2020 of the dot-com bubble, okay, if you would have bought the top 10 public companies then that all had no or almost no revenue, okay, you would have, and you held it to today, you would have massively outperformed the public markets, the S&P 500. You would have created a lot more what we call alpha, return over the S&P 500. Because even though you would have gotten pets.com and insurance.com and whatever.com, you would have gotten, like I said, Amazon, eBay, PayPal. And if you look at what's going on now, because the SPAC is back, the IPO market is back, and they're very correlated, okay? But the SPAC is definitely back. If you look at two areas, for example, that are doing very, very well. There's actually three, but there's two that are doing exceptionally well. One of them is quantum computing. Mm-hmm. One of them is nuclear power. There's another one that's like autonomy, mobile autonomy, specifically for trucking. We already have cars with Tesla.
Automatic driving, etc.
Yeah. Okay. And if you look at all of these companies are going public through SPAC, okay? And they're trading very well. And if you look at the shareholder rosters, who's owning these companies? It's all the same names, okay? The BlackRock, Fidelity, Morgan Stanley, they're buying all of them. Why? Because they're creating that basket, just like people did back in 2000 with the dot-com bubble, okay? Because they don't know which is the quantum computer that is going to win. If I asked you or I asked any of these investors, is it going to be matter or light qubits that are going to be the ones that we're going to use? You can tell me your opinion. you can't tell me you know for sure it's going to be right, because even the companies don't know it's going to be right, and the investors don't know it's going to be right. So they're creating baskets, and it's okay, by the way, for some of these companies to go to zero. That's the way that the market goes.
Yeah, both public and private.
Right, 100%. Okay, 100%. And this is a totally separate concept than what you're referring to with what it seems to me was the first real Israeli experience with SPACs.
Yeah, 2021.
Right, 2021, 2022. And it was going right into the biggest growth equity bubble burst in 43 years. 2021 and 2022 and 2023 had the lowest amount of IPOs in 43 years. Predating even the dot-com bubble burst. It was worse than that. Okay. And how do you know? Without even having to check that, I bet some of your listeners are aware of the fact that in those 2-year period, that Tiger Global, the poster child for tech investing, right? Throwing term sheets everywhere, not just in the States, in Israel too. And I'm sure some of your listeners know that. They were down 75%. Okay. How else do you know? Do you know in those 2 years how much Facebook was down? 77% their stock went down. Wow. This is a company that was printing $1 billion a week in free cash flow, and their stock went down 77%. That was a proper growth equity bear market. So if you look at what creates a growth equity bear market, okay, a bubble before it. The bubble pops, okay? So if I'm telling you that this was the worst growth equity bubble popping in 43 years, predating the dot-com one, then you shouldn't be surprised to learn that what the geniuses did first, the fools did later, and 2021 and 2022 were the years of bringing the companies public that shouldn't have gone public.
Yeah. So let's move on into Gesher and your specific model. After we give kind of like a brief of the good and the bad, or the latest bad of what SPAC is in general, unrelated to Gesher. Maybe tell a bit about your model, the way you see things, what kind of companies are you looking for?
Sure. So I think, first of all, it actually starts with size of the company. Okay, the bulge bracket investment banks, the UBSs, Goldman Sachs, JP Morgans of the world, they're prepared, I think, probably better than anyone, to take the largest companies public. Right. You probably read just last week that SpaceX wants to do a $1.5 trillion IPO, which is crazy. That shouldn't go public with a SPAC. I think that needs some kind of a different distribution network. Okay. But let's say there's a company that's your valuation is 1 billion, 2 billion, 5 billion, something like that. The bulge bracket banks, they don't want to touch that now. They're busy. Okay.
They're busy with the higher SPACs.
With the bigger ones. The bigger IPOs.
Yeah.
Okay. And they don't have the motivation. Their sales forces that are, these huge trading desks that have to service all of the largest institutional clients globally. Okay. It's not economic for them to take a company public for $1 or $2 billion, but that doesn't mean that a company that's worth $1 or $2 billion doesn't deserve to be public.
Yeah.
Okay. And this has been a tale as old as time. We've always had small cap, mid cap, big cap, right?
Yeah.
And typically, companies that you could be the best company in the world at whatever you're doing, whether it's, making electric motors or semiconductors or cybersecurity software.
Yeah.
But you don't really, you've never really taken a company public before. You don't know what the capital markets are like, what the steps are like. So you need an investment banker. Okay, now an investment banker can, or a capital markets expert could be someone like Goldman Sachs or UBS that takes, SpaceX public, or it can be a SPAC sponsor team that helps take you public. Okay,
yeah.
And at the end of the day, there's really only two differences between a SPAC and an IPO. Okay, in an IPO, the bankers take their fee in cash. Okay, now of course they want the stock to go up. Of course they want to help their clients as much, but if it does or it doesn't, they get their fee.
They get their share anywhere.
They get their fee in cash. Okay.
Yeah.
In a SPAC, the bankers, the SPAC sponsors like myself, we get our fee in shares of the company. So we don't make anything if it doesn't work out. So when you look at This is myth number 1, or maybe it's myth number 20. I don't know what you said, that people say, well, everyone's just getting fees and making money and for the SPAC. It's tilted.
It's not true.
It's not true.
Okay.
The SPAC sponsors get locked up with their stock alongside of management. If they take a company public at $10 a share and it goes to $1 a share, they lose all their mony, or almost all their money, right? If it goes bankrupt, they lose all their money, and they get sued for it too. Because I promise you, I don't promise you, I know every single one of those SPACs that, went public and went to zero, they're all getting sued now. Okay. Yeah. So there isn't some kind of like a unfair game or unfair structure for the sponsors. The sponsor is riding shotgun right alongside the management.
So the interests are aligned. That's what you're saying.
The interests are aligned. Okay. But getting back to your question, and you said, so what am I looking for? So I'm starting from the point that I'm looking in this realm that needs help to go public. That's not in that other realm. It's in a size realm, right?
Is it similar to Verana in the sense that you're looking only for דיפ-טק companies, or not necessarily?
So not necessarily, but obviously that's an area that we know better. Okay. So of course, you start, with where you are, but it's different when the company's ready to go public because more about, let's say, that enterprise software company.
Yeah.
If they're getting ready to go public, I already have data points now to know what CTO's decision making is like, because I've seen them in the market with the product.
Yes.
As opposed to someone just showing me the new design or the GUI or whatever of that enterprise software. So in that sense, I can, look at companies that are outside of that.
Yeah.
Earlier on, I'm not doing that, as we talked about earlier.
Got it.
So again, we talked about size. The second thing is, I do SPACs in the U.S. also. Gesher is specifically a product for Israel. So the second qualification the first qualification for Gesher is Israel. And the product is really great for the Israeli market. It's not bad, because these are of course you have the cyber arcs that are going to be, multi-decacorn companies, but most of the companies in Israel that are set to go public, they're kind of $1 to $5 billion, range. So it's very good for the Israeli market. We look for exceptional management teams. We want, we want to find CEO that's going to be a good public CEO. And there's a difference. Sometimes you can have you can have a CEO that is great at running a company, but may not be great at, being a public company CEO.
Yeah.
Okay. Like when you take a company public and you're the CEO of the company, you are the central banker of XYZ stock, whatever your ticker symbol is.
Yeah.
Meaning that it is your job to defend the value of that stock. Not everybody's suited for that. So,
yes.
We look for that. We look for companies that are market leaders in their space, that are addressing very large markets that are ready to be disrupted. We call it like the double tailwind. We're looking for some industry where the pie is growing, meaning that this is use electric vehicles as an example. Okay. The electric vehicle pie is growing. It's growing faster than, the ICE vehicle area. And then we're looking for the company that's going to come in and do that. That's going to be taking a larger share of that growing pie, so that inevitably, when there is a recession or when there is something that goes wrong and you have a wind in your face, you've got the double tailwind behind you. So even if one of them, which is the pie, starts growing slower, you can still win. And these are the type of things, by the way, that, I looked for also when I was running public portfolios at UBS. It's the same, It's the same concept. And so, it sounds simple it's simple to say, right? Great management, great industry, growing pie, taking share. It's hard to find.
It's hard to find. And I'm also trying to kind of like realize, if I'm looking at startups in Israel, Israeli founders that I meet every day, like what would be the threshold for them to reach out to you? Would you take an early stage company to the public market? Like, how do you differentiate between what can be a fit and what's not?
So listen, it's as much an art as a science. Okay. It's not necessarily the number of years that a company has been around. It's not necessarily the amount of revenues that they've had around. It's about what is the industrial logic to go public, okay? So I always tell founders, I say, listen, you don't go public to ring the bell at the NASDAQ. That's not the reason, right? There has to be some other industrial logic. I'll give you an example of a couple just so you can understand, right? Let's say that your competitors are all going public. Quantum computing is a great example. You see all the quantum computing companies going public, and they're raising a ton more capital in the public markets than you can raise in the private markets. This is a good industrial logic. It's an arms race going on, and you're not going to win the arms race if you're not in the arms race.
Yeah.
Okay? That's one example. Let's say that you're in an industry where your customers and your suppliers on both sides of you are very large public companies. Okay. And it's important for you to show transparency to them, to let them know that you're going to be around, that you have the staying power.
Yeah.
When you go public and you put cash on your balance sheet and you publish quarterly income, cash flow, balance sheet statements, people can actually look at you. There's transparency now and say, whoa, this company actually, you know what?
They perform well.
They're performing well. They're good to do business. I mean, I hear a story all the time with private companies where they get in the door with some big Fortune 500 company to win a big contract, and then and somehow they don't close it because that Fortune 500 company is worried that that this particular supplier, this particular company is not going to be around.
Yeah, they're going to be gone.
Yeah, that they're not going to have so that's a great industrial logic too. Like use enterprise software again as an example, okay? One of the reasons why, and again, we've all talked about the survivorship bias, about how we hear about the great stories about these companies that work. You want to know why they almost never work? Because when a CTO has to rip software out of their enterprise and put in a new company, and they don't know if that new company is going to be around next year, the year after that, that's a tough decision to make. So even when they see a product and the product looks great and they show it to some of their, salespeople or their managers or whatever, and they say, this is great, it's still a big leap of faith. Okay. Yeah. So that's another great industrial logic. But the point is that there's not one particular reason only to go public, but there has to be an industrial logic. It can't just be, I want to be public. It can't just be, I want to ring the bell. There has to be industrial because the investors in the public market, they see through that. Okay. I'll give you one more example and then, feel free to move us on or talk about something else. Okay. Yeah. Roll-up strategy, acquisition strategy. There's a lot of companies that have a particular business model where they can acquire other small mom and pop competitors, and there's a long runway to do that. And the public markets love that. They love that. The sell side analysts that write research on it, they love being able to look at it and say, wow, this company's got a pipeline of roll up small mom and pop things that are in the business that they're in. And they need to have the public currency, both debt and equity from the public markets to do this. That's a great industrial logic. So there's lots of good reasons. And of course, there's lots of bad reasons, right?
What would be bad reasons to take a company public?
A bad reason to take a company public is because you are desperate for money. You think that you can tell a story that will get people excited and you'll get that money, but you're telling yourself a lie, because even if you get that money, you know perfectly well that you actually need 4, 5, 10 times more that much money, and that's a bad reason. That's tough. And then obviously, everything psychological, like ego or whatever. I want to be a public company, or I want to, do this. But it's, we know it when we see it. And you ask the question, who should reach out? And the answer is everyone every entrepreneur in Israel that thinks that their company is ready to go public and needs a great partner to help them do that.
Cool. So speaking about Israel, let's maybe close the loop and the conversation around that. You've been into the public or the intersection of public and private market, both in the States and in Israel. How do you see Israel as an opportunity right now, considering the fact that we're getting after, tough 2 years, the political sentiment is not as good, economy is strong, but still there are some risks to it.
Yeah, I mean, listen, the war had lots of negative impacts on the country in so many ways, not only geopolitical, economic, and so many ways. And unfortunately, many companies, startup companies in the ecosystem have died or are dying, and more will die. Mm-hmm. The dry powder from the Israeli VCs seems to be dried up. Some of that extra help from the IAA that was, giving the fast track loans when the war started kind of dried up. That's an unfortunate reality of a shock to the system like this. Okay. However, the companies that are surviving are stronger than ever. And we see this every day. Mm-hmm. We really do. And, the countries that we've seen, foreign countries like European countries and some Asian countries that were before the war putting a lot of money into Israel, bringing a lot of money. They actually, there was a lot of Asian and European VCs and CVCs that had opened up offices, as I'm sure you're aware, in Tel Aviv prior to the war. They packed up and ran away.
That's true.
Okay.
That's true. You can really see a difference between American-based entities that actually doubled down and tripled down during the war. And if I would be generalistic about it, because you have to generalize in order to make an argument, European and Eastern Asians actually retreated and shy away and are now shying away from this market. That's
right. But I think, and I completely agree with the point you just made. I think that the interest or the strength in the U.S. market to Israeli tech has grown, and we're probably just at the beginning of what people would call green shoots of that. Like what's to come is going to be much bigger. I'll give you an example. Defense tech. Okay. So many companies, as you're aware, in Israel that maybe weren't even in defense tech, but it's something adjacent to that. Mm-hmm. During the war, made some sensors or some products, some drones, whatever it was, for the war efforts. And in the United States, defense tech investors, as well as the DOD, the Department of Defense, or I guess it's called DOW right now.
Yeah, like the equivalent of the Ministry of Defense here in Israel. Yeah.
They like to see something in the theater, in the war theater, to see how it's performed. They've seen that now, and it's hot. Whereas the Europeans are completely running away from this. Okay, U.S. is running towards it. Yeah. And we see it also in other ways because, if you were prior to the war, I mean, not prior to the war, but now too, if you are an Israeli defense tech company and you want to get in with the DOD, okay, there's one of two ways to do it. Like you can either partner with someone like, Elbit or Raphael that already is selling into it and you can become a supplier to them. Yeah. Or you have to find a partner in the States where you can manufacture and you can do something there. That latter route, I've seen the timelines for that getting completely shortened. Like companies are able to do that much quicker now in the United States than they were prior to the war. Yeah. And that's a good thing. And that is kind of like a hook, I feel like, that's bringing the U.S. closer and more to Israel. And if I'm honest, you know what? If I had to have a trade-off, and I hope and think you would agree with me, lose France and Germany, get the United States more, I think that's a good trade-off.
Yeah, and extreme times kind of reveals who are the true friends and who are the people that won't be there for you maybe when you need them. Yeah. So yeah, that's something that I can definitely relate to. So Ezra, before we wrap up, maybe some last few pointers for Israeli founders that want to engage with you.
Yeah, I would say first of all, anyone should reach out to me anytime. I'm happy to talk about what I see. During the war, I was spending a lot of time. I met with many Chevre Knesset and people from the Ministry of Finance to tell them, because I have a perspective or a look into, what's going on in the U.S. market, and I'm coming back and forth all the time. And even if it's nothing to do with Gesher or anything like that, if people want to reach out and talk about what's going on in the U.S. market, and my passion is Israel. I hope that's come through, and I'll happy to help anyone that wants to get connections in the U.S. for bringing business there, bringing money there. Feel free to reach out, and this is brighter times are ahead. I'm confident of that.
Ezra, it's been a pleasure. Thank you very much for your time, and hope to see you on your next visit to Israel.
Thank you so much for having me.